There's the qualified charitable distribution, which expires at the end of this year. Of course, it's expired at the end of several prior years too. It keeps being renewed. But it's a way, if you're over 70 and a half, to transfer money directly from your IRA to a public operating charity. And it's extremely valuable because for any client who's over 70 and a half and has charitable intent, it's a way to fund your charitable gifts in a very income tax advantaged way. And clients should not overlook this, because the money goes directly from the IRA to the charity, so it's not part of your adjusted gross income. If you take money out of your IRA and put it in your checking account and then write a check to charity, you get a tax deduction, but the IRA distribution goes into your gross income. The deduction for the charitable gift reduces your taxable income, but not your adjusted gross income. And adjusted gross income matters for Medicare premiums, medical expenses, taxability of Social Security benefits, and under the new tax law, phase out of personal deductions, the new surtax on investment income. All of those things are affected by adjusted gross income, and you just bypass it by making a gift directly. And the good thing I like about this especially, it's not just one of the tax things that just benefits very high income individuals. It's across the board. Even lower income individuals get a super benefit out of it if they want to make charitable gifts, because it may reduce the taxation of their Social Security benefits. It may enable them to use the standard deduction even though they're getting the itemized deduction effectively by making a charitable gift. So qualified charitable distribution's great, always a good idea. Flip the coin. You can also transfer money directly from your IRA to a health savings account. And strangely enough, I don't think that's useful for just about anybody. I mean, there may be a rare case, but here's why that's not useful. First of all, health savings accounts are great. I love health savings accounts. If you make a contribution to a health savings account from your checking account, you get a deduction towards adjusted gross income. In other words, the deduction comes out of your gross income, so it's super valuable. And then when you take distributions out of the health savings account, the distributions are tax-free if they're used to pay medical expenses. Tax-deductible contributions, tax-free distributions, what's not to like? But the idea of funding it with transfers from the IRA, that's the part that's not a good planning idea for most people. Because most people are better off, if they want to fund a health savings account, write a check from your checking account, get the deduction on your tax return. If you pay it from your IRA, you don't get any deduction. So that's my best and worst as far as the code's permitted direct transfers into different kinds of entities. One's good, one's bad.